You've heard it before. When the markets become erratic or seem poised for a prolonged downturn, the best thing you can do is absolutely nothing at all. But if you're on the cusp of retirement, or perhaps worse, newly retired, a turbulent stock market can make you feel particularly vulnerable. Joining me is Tim Tremblay with Tremblay Financial Services in Santa Barbara, California. Welcome, Tim. It's been said that market losses or corrections are actually worse for retirees. Why is that the case?
Well, you look at what the market can do. And if you're in the stock market, you can make a lot of money, but you can also lose it. And time mitigates risk. And if you don't have the time to be in the stock market, then you're taking more risk than you should, especially with your retirement assets. You could see a volatile market come along right when you want to retire, and you can see the amount that you have to work with dwindle dramatically. So it's real important as you get into retirement planning that you have that really taken care of and protecting your principal.
So talking about sequence of returns risk, why is that so important to consider?
Well, when you look at the sequence of returns, you're generally talking about the stock and bond market. The markets go up and down, and you have to look at the returns as you're taking money out, and they have these different rules that they've come up with, the 4% rule, for example. That works great until it doesn't. You look at the 10-year period from 2000 to 2010. If you'd invested $100,000 in 2000, 10 years later, you'd have a 20% decline in what you started with. That is not good news for those that are retiring. So it's real important that you have protection of principal, especially as you get closer to retirement. And the time that you have to work with in the stock market when you're looking at preserving that principal is now further out. We used to use 7 years, now it's a 10-year period. If you don't have 10 years, you really need to be careful with how much you have in the stock market.
Now, traditional safe money options have always been things like bonds and CDs, but they aren't as attractive now. What other options are there?
Yeah, you're looking at interest rates that just haven't kept up with inflation with the traditional safe money. So what we're looking now at for our clients in the foundation, the safe money, would be fixed indexed, annuities, it's insurance programs where you know that your principal is going to be protected and you still have a great opportunity for significant returns during a time when the market might be very volatile.
My guest has been Tim Tremblay with Tremblay Financial Services in Santa Barbara, California. Thank you for watching Retirement News Online.